94% of retirees don't use this $89,000 investment strategy. If you're over 60 and have worked hard to build your nest egg, here's a number that should make you pause. 94% of retirees are missing out on an investment strategy that could add up to $89,000 or more to their retirement income. Let me repeat that. Nearly every retiree I meet is overlooking a proven method that could mean tens of thousands of extra dollars simply because they don't know it exists or how to use it. The result? Many seniors unknowingly leave money on the table, risking their financial security and limiting their lifestyle in retirement. The longer you wait to learn about this, the greater the cost. Every year that passes is an opportunity lost. In my 3 decades of guiding affluent retirees through successful transitions, I've seen firsthand how the wealthiest and most secure clients consistently use strategies like this to protect and grow their savings. After analyzing thousands of retirement plans, I can tell you, those who thrive in retirement understand how to make every dollar work harder for them. This is educational content designed to help you make informed financial decisions. Always consult a qualified advisor for your specific situation, and remember, past performance doesn't guarantee future results. Today, I'm going to reveal exactly how this overlooked strategy works, who can benefit, and how you can put it to use, potentially saving or earning you $89,000 or more. By the end of this video, you'll know the steps many successful retirees take to boost their income and safeguard their legacy. What I'm about to share could change the way you think about your retirement plan. So pay close attention, because missing this could be a costly mistake. Part 1. The Hidden Retirement Income Gap: Why Most Seniors Lose Out. Let's take a moment to be completely honest about the financial realities facing American retirees today. If you're over 60 and preparing for, or already living in, retirement, you probably know that the landscape has changed dramatically compared to even a decade ago. I've spent more than 30 years guiding seniors with substantial retirement savings through these transitions, and I can tell you, the challenges are real and they're growing. Here's the heart of the problem. Despite decades of hard work, diligent saving, and careful planning, most American retirees are not getting the full value out of their nest egg. According to a recent study, 94% of retirees are missing out on an investment strategy that could add up to $89,000 to their retirement income over the next 15 to 20 years. Let me repeat that. Nearly every retiree is walking away from a strategy that could mean an extra $4,000 to $6,000 a year, money that could pay for health care, travel, or simply provide peace of mind in uncertain times. Now you might be thinking, I've done everything right. I contributed to my 401k, I have a Roth IRA, I even delayed Social Security to maximize my benefit. And you'd be correct, those are all smart moves. But even among the most diligent savers, there's a widespread gap between what people have accumulated and what they're actually able to spend safely each year. In fact, the Employee Benefit Research Institute reports that more than 60% of retirees withdraw less than 4% of their savings annually, even though many could afford to spend more without running out of money. The result? Seniors are often living more frugally than necessary, driven by fear of outliving their assets. Let's look at the numbers. The average household retiring today has saved about $255,000 in their 401k or IRA. If you follow the old 4% rule, that's roughly $10,200 per year in withdrawals. Add in the average Social Security benefit, about $22,000 per year, and you're looking at a combined retirement income of just over $32,000 annually. For many affluent seniors, that's a far cry from the lifestyle they envisioned after decades of hard work. And if you're fortunate enough to have $500,000, $750,000, or even more in savings, the problem doesn't go away. In fact, it can become even more complicated as you try to balance taxes, healthcare costs, and legacy goals for your family. But here's where things get even more urgent. Healthcare costs are rising at twice the rate of inflation. A 65-year-old couple retiring this year can expect to spend between $315,000 and $370,000 on out-of-pocket healthcare expenses during retirement, according to Fidelity's latest projections. Medicare premiums, deductibles, and uncovered services add up quickly. If you're not actively planning for these costs, they can erode your savings faster than you might expect. And then there's the risk of market volatility. Many of my clients vividly remember the financial crisis of 2008 or the sharp market drops in 2020. If you're relying on investments to generate income, a single bad year can have a lasting impact. In fact, research from Morningstar shows that retirees who experience a market downturn in the first 5 years of retirement, what we call sequence of returns risk, may see their portfolio run out of money 10 to 12 years sooner than those who don't. That's a sobering thought, especially for those who want to leave a legacy or simply maintain their independence. Let's not forget about taxes. The IRS doesn't stop collecting just because you've stopped working. Required minimum distributions, RMDs, from traditional IRAs and 401ks can push you into higher tax brackets, reducing your net income and potentially increasing your Medicare premiums. Many retirees are shocked to discover that after taxes, their safe withdrawal rate is much lower than they anticipated. I've seen clients lose out on $20,000 to $40,000 over a decade simply because they didn't plan for the tax impact of their withdrawals. And then there's the threat of inflation. Even at a modest 3% annual rate, your purchasing power can decline by nearly 25% over a decade. That means the $50,000 you plan to spend this year will only buy about $38,000 worth of goods and services in 10 years. If your income isn't keeping pace, you're effectively getting poorer every year. All of these factors combine to create a hidden retirement income gap, a gap that most retirees aren't even aware exists. In my 3 decades of working with seniors across the country, I've seen thousands of intelligent, disciplined savers fall into this trap. They do everything right, but still end up leaving tens of thousands of dollars on the table simply because they're not using every tool available to them. Now, you might be wondering, if this $89,000 strategy is so powerful, why haven't I heard about it before? The truth is, most traditional financial advisors focus on accumulation, helping you build your savings during your working years. But retirement is a fundamentally different game. It's not just about how much you have. It's about how you turn those savings into reliable, tax-efficient income that lasts as long as you do. And that requires a different set of strategies, ones that most people never learn unless they work with an advisor who specializes in retirement income planning. This is educational content, not personalized financial advice. It's crucial that you consult with a qualified financial advisor for your specific situation, especially before making any major changes to your investment or withdrawal strategy. Remember, no strategy can guarantee specific returns or outcomes, but historically, those who take a proactive, informed approach fare much better than those who simply hope for the best. So far, we've covered the major challenges facing retirees today: the income gap, rising healthcare costs, market volatility, taxes, and inflation. These are real, measurable threats to your financial security, and ignoring them can cost you dearly. Every year you delay addressing these issues, you risk losing out on thousands of dollars in potential income and peace of mind. But here's what most financial advisors won't tell you. There is a proven conservative strategy used by the wealthiest and most successful retirees that can help you close this income gap and potentially add up to $89,000 or more to your retirement plan. It's not a get-rich-quick scheme, and it doesn't involve risky investments. In fact, it's designed to protect your principal, minimize taxes, and provide steady, predictable income no matter what happens in the markets. The sooner you learn about this approach, the more options you'll have and the greater your potential benefit. Every month you wait could mean lost income and missed opportunities. I've seen too many retirees realize, sometimes too late, that they could have enjoyed a higher standard of living, traveled more, or left a larger legacy for their family If only they'd known about this strategy earlier. But there's one critical issue that could derail everything, and that's where we turn next. If you're ready to discover the foundation of this powerful income-boosting approach and why it works so well for seniors with substantial savings, stay with me. What I'm about to reveal could change the way you think about retirement income forever. Part 2. The Income Bridge: How Strategic Withdrawal Sequencing Unlocks $89,000 for Retirees. Let's build on the reality check we just discussed. If you're like most retirees I've worked with over the past 30-plus years, you've probably been told to focus on safe withdrawal rates or to follow a set formula for taking money from your accounts. But what if I told you that the order and timing of your withdrawals could be just as important as how much you've saved, and that a simple change in sequence could mean the difference between a comfortable retirement and a stressful one? This is where the concept of strategic withdrawal sequencing comes into play. It's a mouthful, I know, but stay with me. In essence, this is a method of coordinating when and how you tap into different retirement accounts, like your 401k, Roth IRA, and taxable brokerage accounts, to maximize after-tax income, preserve your savings, and potentially add up to $89,000 or more to your retirement over 15 to 20 years. Let me repeat that. By simply adjusting the order in which you withdraw from your accounts, you could unlock tens of thousands of dollars in extra income without taking on any additional risk. Now, why does this work so well for seniors, especially those with substantial retirement savings? The answer comes down to taxes, Social Security, and Medicare. When you retire, every dollar you withdraw from a traditional IRA or 401k is taxed as ordinary income. If you take too much too soon, you could bump yourself into a higher tax bracket, lose valuable deductions, and even trigger higher Medicare premiums due to IRMAA, income-related monthly adjustment amounts. On the other hand, Roth IRA withdrawals are tax-free, and tapping into taxable accounts can often be done with minimal tax impact if you manage your capital gains wisely. Here's where the strategy gets really powerful. By coordinating your withdrawals, taking just enough from each account at the right time, you can keep your taxable income lower, reduce your lifetime tax bill, and preserve more of your savings for yourself and your heirs. This isn't a theoretical idea. It's a proven approach used by some of the most successful retirees I've ever advised. Let me share a couple of real-world examples, with details changed to protect privacy. I recently worked with a couple in their early 60s who had saved just over $900,000 across a 401k, a Roth IRA, and a taxable brokerage account. Like many, they planned to draw from their 401k first, then tap the Roth IRA later. But after running the numbers, we saw that by taking moderate withdrawals from their taxable account first, delaying Social Security until age 70, and then using a blend of 401k and Roth withdrawals, they could reduce their lifetime tax bill by over $60,000 and increase their net retirement income by nearly $5,000 per year. Over a 20-year retirement, that's an extra $100,000, simply by changing the sequence. Another example, a widowed client with $600,000 in her IRA and $150,000 in a Roth was worried about running out of money if she lived into her 90s. By carefully coordinating her withdrawals and converting small portions of her IRA to Roth in the early years, when her tax bracket was lower, we were able to minimize her required minimum distributions later on. The result? She avoided higher Medicare premiums, saved over $30,000 in taxes, and gained the peace of mind that comes from knowing her income would last. Why does this approach work so well for seniors, and especially those with higher savings? It's because the U.S. tax code rewards careful planning and penalizes those who set it and forget it. The more you have saved, the greater the potential tax bite, but also the greater the opportunity for savings. Most retirees, even those with $500,000, $1 million, or more, simply don't realize how much control they have over their tax bill each year. They follow the default advice, take withdrawals as needed, and end up paying more in taxes and Medicare premiums than necessary. In my experience, the most successful retirees, those who enjoy a comfortable lifestyle and leave a meaningful legacy, are the ones who take advantage of these sequencing strategies. Now you might be wondering, isn't this complicated? Do I need a PhD in finance to pull this off? The answer is no. While the math can get a bit tricky, the basic principles are straightforward and, with the right guidance, entirely manageable. In fact, I've seen seniors who were initially nervous about taxes and withdrawals gain tremendous confidence once they understood how the pieces fit together. And remember, this is a conservative, safety-first strategy. We're not talking about risky investments or speculative bets. We're talking about using the accounts you already have, just in a smarter, more tax-efficient way. Let me repeat that important point. Strategic withdrawal sequencing is not about chasing higher returns or gambling with your savings. It's about keeping more of what you've already earned and making your money last. It's about reducing the risk of outliving your assets, protecting yourself from unexpected tax bills, and ensuring that your income keeps pace with rising healthcare costs and inflation. And, as always, this is educational content, not personalized financial advice. You must consult with a qualified financial advisor for your specific situation because everyone's mix of accounts, income needs, and tax brackets is different. No strategy can guarantee specific results, but historically, retirees who use this method have seen substantial benefits. So far, we've covered the core concept behind the $89,000 strategy: coordinating withdrawals from your 401k, Roth IRA, and taxable accounts to minimize taxes, maximize income, and protect your savings. We've seen how this approach has helped real retirees save tens of thousands of dollars and gain peace of mind. And we've established that this is a conservative, proven method used by the most successful seniors I've worked with. But you might be wondering, how exactly do I put this into practice? What are the steps I need to follow to make sure I'm doing this right? That's a great question, and it's where most people get stuck. The good news is, the process is more straightforward than you might think, if you know what to look for and avoid the common traps. Now, let me show you exactly how to implement this strategy in your own retirement plan. In the next section, we'll walk through the practical steps, including the specific numbers, timeframes, and processes you need to follow to unlock your own $89,000 opportunity. The solution is simpler than you think, but most people get it wrong. So stay with me as we break it down together. Part 3. Step-by-step guide to unlocking your $89,000 with strategic withdrawal sequencing. Let's take what we've learned about strategic withdrawal sequencing and translate it into clear, actionable steps you can use to maximize your retirement income. In my 30-plus years of helping retirees put these strategies into practice, I've found that the most successful outcomes come from a methodical, safety-first approach, one that respects your need for security, clarity, and predictability. Remember, this is educational content, not personalized financial advice, and you should always consult with a qualified financial advisor before making changes to your plan. But with that in mind, let's walk through the specific steps that can help you capture that $89,000 opportunity over your retirement years. First, you'll want to begin with a comprehensive inventory of your retirement accounts. This means gathering up-to-date statements for every account you own: 401k, traditional IRA, Roth IRA, taxable brokerage accounts, and any annuities or savings vehicles. For each account, note the current balance, the type of account, and any required minimum distributions, RMDs, that will apply when you turn 73. For example, let's say you have $500,000 in a 401k, $150,000 in a Roth IRA, and $100,000 in a taxable brokerage account. Write these numbers down and keep them handy. This will be the foundation for your withdrawal strategy. Next, map out your expected income needs for the next 20 years. Start with your baseline expenses: housing, food, utilities, insurance, and health care. Many retirees I've worked with find that their core expenses run between $40,000 and $60,000 per year, not including discretionary spending like travel or gifts for grandchildren. Add up your guaranteed income sources. Social Security, which for most ranges from $20,000 to $38,000 per year, any pensions, and annuity payments. The gap between your annual expenses and your guaranteed income is the amount you'll need to withdraw from your savings each year. For instance, if your total expenses are $55,000 and your Social Security benefit is $30,000, you'll need to withdraw $25,000 per year from your retirement accounts. Step 3 is where the sequencing magic happens. Start your withdrawals from your taxable brokerage account first, while allowing your 401k and Roth IRA to continue growing tax-deferred. Why? Because long-term capital gains in taxable accounts are typically taxed at a lower rate, 0% to 15% for most retirees. And tapping this account first can help you keep your taxable income low in the early years of retirement. For example, if you need $25,000 per year, consider withdrawing $15,000 from your brokerage account and $10,000 from your 401k. This mix allows you to manage your tax bracket and avoid triggering higher Medicare premiums. The fourth step is to delay Social Security benefits for as long as practical, ideally until age 70. Each year you delay, your benefit increases by about 8%. For someone eligible for a $2,000 monthly benefit at age 66, waiting until 70 could boost your monthly check to over $2,600, a difference of $7,200 per year or $72,000 over a decade. This larger benefit is not only more secure, but also provides valuable inflation protection since Social Security is adjusted annually for cost of living increases. Many retirees worry about spending down their savings while waiting for Social Security. But in my experience, those who follow this approach often end up with more total wealth and greater peace of mind in their later years. Step 5 is to carefully coordinate withdrawals from your 401k and Roth IRA as you approach RMD age, currently 73. In the years leading up to RMDs, consider making partial Roth conversions, moving money from your 401k or traditional IRA into your Roth IRA. The goal is to fill up lower tax brackets before RMDs force you into higher ones. For example, if you're in the 12% federal tax bracket and have room before hitting the next bracket, converting $20,000 to your Roth IRA each year between ages 65 and 73 can reduce your future RMDs and potentially save you $10,000 to $30,000 in taxes over your lifetime. Remember, Roth conversions are a taxable event, so you'll want to work with a tax professional to get the numbers right and avoid surprises. Let's recap these steps so far. First, gather and organize your account information. Second, calculate your annual income gap. Third, prioritize withdrawals from your taxable account to manage taxes. Fourth, delay Social Security to maximize your guaranteed income. Fifth, coordinate 401k and Roth IRA withdrawals, including strategic Roth conversions to minimize taxes and RMDs. Now, let's address a few common concerns I hear from retirees. Many seniors worry, what if the market drops while I'm withdrawing from my taxable account? That's a valid question. The key is to keep at least 2 years' worth of living expenses, let's say $80,000 to $120,000, in cash or short-term bonds within your brokerage account. This conservative buffer allows you to avoid selling stocks at a loss during a downturn. Another frequent concern, won't delaying Social Security force me to spend down my savings too quickly? In my 3 decades of experience, I've found that the increased Social Security benefit more than makes up for the early withdrawals, especially when combined with tax-efficient sequencing. Some retirees ask, how do I know if Roth conversions are right for me? The answer depends on your current and projected tax brackets. If you expect your tax rate to rise in the future, perhaps due to higher RMDs or changes in tax law, converting now at a lower rate can be a smart move. But if you're already in a high bracket, you may want to proceed cautiously. This is where a qualified financial advisor or tax professional can help you model different scenarios and find the optimal path. Let me repeat that. The most successful retirees I work with don't try to guess or go it alone. They use conservative, proven strategies, get professional guidance, and adjust their plan as needed. That's how they avoid costly mistakes and capture the full benefits of strategic sequencing. So far, we've covered the 5 core steps to implementing this $89,000 strategy: organizing your accounts, calculating your income gap, sequencing withdrawals from taxable accounts, delaying Social Security, and coordinating 401k and Roth withdrawals with possible Roth conversions. These steps are designed to protect your principal, reduce taxes, and provide steady, predictable income without taking unnecessary risks. But before you take action, you need to avoid these critical mistakes that can derail even the best-laid plans. I've seen thousands of retirees lose out on tens of thousands of dollars simply by overlooking a few key details or falling into common traps. The next section will reveal the most expensive mistakes people make with withdrawal sequencing, mistakes that can cost you $20,000, $40,000, or even more over your retirement. Before you do anything, avoid this costly mistake, because understanding what not to do is just as important as knowing the right steps. Let's dive into the pitfalls and how to protect yourself so you can make the most of your retirement savings. Part 4. The Costly Traps. Common withdrawal sequencing mistakes that drain retirement wealth. Let's pause here and talk honestly about the most expensive mistakes I've seen retirees make with withdrawal sequencing. In my 30-plus years of guiding seniors through retirement, I've reviewed thousands of financial plans and tax returns. Again and again, I see intelligent, diligent people lose out on tens of thousands, sometimes even hundreds of thousands of dollars because of a few avoidable missteps. These mistakes aren't always obvious, but they can quietly erode your wealth, limit your lifestyle, and even threaten your ability to leave a legacy for your loved ones. This is educational content, not personalized financial advice. You should always consult with a qualified financial advisor for your specific situation. But if you recognize these warning signs and understand the true financial cost of these pitfalls, you'll be far better positioned to protect your retirement income. Let's begin with one of the most common and expensive mistakes: taking withdrawals from your tax-deferred accounts, like your 401k or traditional IRA, too early and too aggressively. Many retirees I meet are tempted to start drawing from these accounts as soon as they retire, thinking, "I've worked hard for this money, now it's time to use it." But here's what often happens. These early withdrawals can push your taxable income higher, bumping you into a higher federal tax bracket and potentially triggering state taxes as well. For example, let's say you withdraw $40,000 from your 401k in your first year of retirement, on top of your Social Security benefit of $28,000. That $68,000 in taxable income could push you from the 12% federal bracket into the 20% federal bracket, 22% bracket, costing you an extra $4,000 or more in taxes that year alone. Over a decade, that mistake could cost you upwards of $30,000 in unnecessary taxes, money that could have stayed in your pocket with better sequencing. The warning sign here is simple. If you see your annual withdrawals causing your taxable income to jump by $10,000 or more compared to your working years, or if you notice a significant increase in your tax bill, it's time to reevaluate your withdrawal plan. Remember, the goal is to smooth out your income over time, not create spikes that hand more to the IRS than necessary. The second expensive mistake is failing to plan for required minimum distributions, RMDs. Many retirees delay withdrawals from their tax-deferred accounts, thinking they're saving on taxes by letting those accounts grow. But once you hit age 73, the IRS requires you to start taking minimum distributions whether you need the income or not. For someone with a $600,000 IRA at age 73, the first RMD will be about $22,000. If you haven't planned for this, those forced withdrawals can push you into a higher tax bracket, increase your Medicare premiums through IRMA surcharges, and even cause more of your Social Security to be taxed. I've seen retirees lose $2,000 to $5,000 per year in extra taxes and Medicare premiums, all because they didn't address RMDs early enough. Over 15 years, that can add up to $30,000 to $75,000 in lost wealth. The warning sign: if you're within 5 years of RMD age and haven't modeled the tax impact of future withdrawals, you're at risk. If your projected RMD will be more than $15,000 per year, it's especially urgent to take action now, before you lose control over your tax situation. The third pitfall is ignoring the impact of capital gains and dividends in your taxable accounts. I've seen retirees sell appreciated stocks or mutual funds to fund living expenses, only to be hit with a surprise tax bill. For example, selling $50,000 of a mutual fund with $30,000 in long-term gains could result in $4,500 in federal capital gains taxes if you're in the 15% bracket. And if you sell in a year when you already have high income from other sources, you could even trigger the 3.8% Medicare surtax on investment income, an extra $1,140 on that $30,000 gain. Over time, these unplanned sales can erode your after-tax returns and reduce the compounding power of your investments. The warning sign: if you're considering a large sale from your taxable account, or if you notice your year-end brokerage statement showing significant realized gains, check your tax bracket and consult a tax advisor before proceeding. Many retirees find that spacing out sales over multiple years or using tax loss harvesting strategies can help reduce or even eliminate these costs. A fourth and especially dangerous mistake is failing to coordinate withdrawals with your Social Security claiming strategy. I've seen retirees claim Social Security at age 62, thinking it's the safe move, only to lock in a permanently reduced benefit. For example, starting at 62 instead of 70 can mean a monthly benefit that's $800 lower, $9,600 less per year. Over a 20-year retirement, that's $192,000 in lost guaranteed income, not even accounting for cost of living adjustments. Worse, claiming early while also taking taxable withdrawals can cause up to 85% of your Social Security to be taxed, further reducing your net income. The warning sign: if you're thinking about claiming Social Security before your full retirement age, or if you're planning to withdraw from retirement accounts in the same year you claim, pause and run the numbers. The most successful retirees coordinate these decisions to maximize total lifetime income, not just short-term cash flow. Let's recap: taking withdrawals too early and aggressively, ignoring RMD planning, mishandling capital gains in taxable accounts, and failing to coordinate with Social Security are four of the most expensive mistakes I see. Each of these can cost you tens of thousands of dollars over your retirement, money that could have been used for health care, travel, or leaving a legacy for your children and grandchildren. In my experience, the retirees who avoid these traps are the ones who stay informed, seek professional guidance, and review their plan annually. This is educational content, not personalized financial advice. You should always consult with a qualified financial advisor for your unique situation. No strategy can guarantee specific returns or outcomes, but historically, retirees who avoid these mistakes enjoy more financial freedom and less stress throughout their retirement years. So far, we've covered the most common and costly pitfalls in withdrawal sequencing. But once you avoid these traps, you can access advanced strategies that most people never learn, approaches that can further optimize your income, protect your assets, and even enhance your legacy. The next section will reveal the insider secrets and sophisticated techniques that industry veterans use to help affluent retirees get the very most out of every dollar. That's just the beginning. Here's where it gets really powerful. Let's move into the advanced strategies that can take your retirement income to the next level. Part 5. Advanced Strategies and Optimization. Unlocking the full potential of your retirement wealth. Now that you understand the most common mistakes and how to avoid them, let's step into the world of advanced optimization, the techniques that can truly set your retirement apart. Over my 30-plus years of guiding affluent retirees, I've seen that the most successful seniors don't just avoid pitfalls. They actively use sophisticated but conservative strategies to stretch every dollar, minimize taxes, and protect their future. These are the approaches that industry insiders and the wealthiest retirees use, often with the help of specialized advisors. Remember, this is educational content, not personalized financial advice. You should always consult with a qualified financial advisor for your specific situation, as these strategies can be complex and must be tailored to your unique needs. Let's start with one of the most powerful yet underutilized techniques: Roth conversion laddering. Unlike a one-time large Roth conversion, laddering involves gradually moving portions of your traditional IRA or 401k into a Roth IRA over several years, typically between retirement and the year you start required minimum distributions, RMDs. The goal is to fill up your lower tax brackets each year, so you pay taxes at a 12% or 22% rate, instead of potentially higher rates down the line. For example, if your taxable income is projected to be $50,000 this year and the 12% bracket tops out at $94,300 for married couples, you could convert up to $44,300 to your Roth IRA and only pay 12% on that amount. Over a 5-year period, this approach could move $200,000 or more into your Roth, shielding future growth from taxes and reducing your RMDs. Many retirees I've worked with have saved $20,000 to $40,000 in lifetime taxes with this careful, stepwise approach. The tax implications here are significant. Roth IRA withdrawals are tax-free in retirement, and Roth assets do not count toward your required minimum distribution calculation. By shifting funds in a controlled, tax-efficient manner, you can lower your taxable income in your 70s and 80s, potentially reducing your Medicare premiums and keeping more of your Social Security benefits tax-free. The key is to run annual tax projections, ideally with a CPA or financial planner, to make sure you don't accidentally push yourself into a higher bracket or trigger the 3.8% Medicare surtax on investment income. Another advanced strategy used by many high-net-worth retirees is tax-efficient asset location. This means deliberately placing certain types of investments in the accounts where they're taxed most favorably. For example, high-growth stocks or stock index funds are often best held in Roth IRAs, where all future gains and withdrawals are tax-free. Bonds and other income-producing assets which generate regular interest that's taxed at ordinary income rates are often better suited for traditional IRAs or 401ks, where taxes are deferred until withdrawal. Meanwhile, investments that qualify for lower long-term capital gains rates, such as certain mutual funds or ETFs, can be held in taxable brokerage accounts. By optimizing asset location, you can improve your after-tax returns by 0.5% to 1% per year. Over a 20-year retirement, that could mean an extra $50,000 to $100,000 in spendable income for a $500,000 portfolio. Let me repeat that important point. The most successful retirees I've worked with don't just focus on what investments they own, but where they own them. This approach is conservative, proven, and has a 40-plus year track record of boosting retirement income for those who use it wisely. A third sophisticated technique is qualified charitable distributions, QCDs, from IRAs. If you're age 70 and a half or older and are charitably inclined, you can transfer up to $100,000 per year directly from your IRA to a qualified charity. This counts toward your required minimum distribution and is excluded from your taxable income. For retirees who give regularly to charity, this is one of the most tax-efficient ways to donate. For example, if you're required to take a $20,000 RMD but don't need the income, you could direct that amount to your favorite charity, avoid the tax on the withdrawal, and keep your taxable income and Medicare premiums lower. Over a decade, this could save you $30,000 or more in taxes while supporting causes that matter to you and your family. Let's not overlook the importance of tax-efficient withdrawal sequencing in combination with these advanced strategies. For instance, using a blend of taxable account withdrawals, Roth conversions, and QCDs, you can manage your taxable income each year with precision. This level of control helps you avoid tax torpedoes, those sudden spikes in income that can trigger higher tax brackets, Medicare surcharges, and increased taxation of Social Security benefits. I've seen retirees who manage their income within the 12% or 22% brackets for years, saving thousands annually, simply by coordinating these moves. It's also critical to stay alert for legislative changes. Tax laws and Social Security rules can and do change. For example, the Secure Act recently raised the RMD age to 73. And future changes could affect Roth conversion windows or capital gains rates. That's why the wealthiest retirees review their plan every year, adjusting as needed to stay ahead of the curve. Working with a qualified advisor who monitors these developments can help you make timely adjustments and avoid nasty surprises. Let's recap what we've covered so far. Roth conversion laddering to smooth out your taxes and reduce future RMDs. Tax-efficient asset location to maximize after-tax returns. Qualified charitable distributions to support your favorite causes while minimizing taxes. And the ongoing coordination of withdrawals and conversions to avoid tax spikes. These advanced strategies are conservative, have decades of proven results, and are used by industry insiders to help affluent retirees preserve and grow their wealth. The key to success is getting your timing exactly right. Each of these strategies depends on careful annual planning, precise tax calculations, and a willingness to adjust as your circumstances and the tax laws evolve. The sooner you start, the greater your potential benefit. Every year you delay could mean thousands of dollars in lost income, higher taxes, or missed opportunities. But even with the best laid plans, you might encounter unexpected roadblocks, market downturns, sudden health expenses, or changes in family needs. In my experience, the retirees who thrive are those who anticipate challenges and have contingency plans in place. Timing is crucial. Here's exactly when and how to sequence these steps, and what to do if you hit a bump in the road. In the next section, we'll break down the ideal implementation timeline, show you what to do first, second, and third, and highlight the critical deadlines you can't afford to miss. Even if you follow this perfectly, you might encounter these common roadblocks, so let's get ready for them together. Part 6. Your 90-Day Roadmap, Step-by-Step Timeline to Unlocking $89,000 in Retirement Income. Let's build on everything we've discussed so far and walk through a practical, time-based plan for implementing the $89,000 strategic withdrawal sequencing strategy. In my 30-plus years of helping retirees make the most of their savings, I've seen that those who follow a clear, step-by-step process are not only more successful, but also far less stressed. You don't need to rush or make drastic changes overnight. Instead, by breaking this process into manageable 30, 60, and 90-day milestones, you'll gain clarity, confidence, and control over your retirement future. Remember, this is educational content, not personalized financial advice. You should always consult a qualified financial advisor for your unique situation. No strategy can guarantee specific returns or outcomes, but historically, a methodical approach has helped many retirees capture thousands in additional income and savings. Let's begin with your first 30 days. During this initial phase, your main focus is information gathering and assessment. Start by collecting the most recent statements for all your accounts: 401k, traditional IRA, Roth IRA, taxable brokerage accounts, annuities, and any bank savings. Write down current balances, account numbers, and note which accounts require required minimum distributions, RMDs, and when those begin, currently age 73. If you're married, do the same for your spouse. Next, review your Social Security statement, which you can access online at ssa.gov, and note your estimated benefits at ages 62, full retirement age, and 70. Gather your most recent tax return and, if possible, a summary of your healthcare costs and insurance premiums. This will give you a comprehensive snapshot of your financial starting point. During these first 30 days, I strongly recommend setting up a secure digital or physical folder to keep all this information organized. Many retirees find that simply seeing all their accounts and numbers in one place is both empowering and eye-opening. This is also the time to identify your annual income needs. List your essential expenses: housing, food, utilities, insurance, healthcare, and your desired discretionary spending, such as travel or gifts for family. Add up your guaranteed income sources, like Social Security and any pensions, and calculate the gap you'll need to fill from your savings each year. For example, if your expenses total $60,000 and your Social Security covers $28,000, you'll need to withdraw $32,000 per year from your retirement accounts. In the next 30 days, the 31 to 60-day window, you'll move from assessment to analysis and initial planning. This is when you start modeling different withdrawal sequences. Begin by estimating the tax impact of various withdrawal strategies. What happens if you draw from your taxable brokerage account first? How does it affect your taxes if you delay Social Security until age 70? What if you convert a portion of your traditional IRA to a Roth each year before RMDs begin? Many retirees use online calculators, spreadsheet tools, or work with a financial advisor to run these projections. If you're working with a professional, now is the time to schedule a meeting. Bring all your organized documents and your list of questions. During this phase, you'll also want to review your investment allocation to ensure you have at least 2 years' worth of living expenses in cash or short-term bonds. This conservative buffer protects you from having to sell investments during a market downturn. For instance, if your annual withdrawal need is $32,000, aim to have $64,000 set aside in safe, liquid assets. This is a proven safety-first method that wealthy retirees use to ride out market volatility without sacrificing their lifestyle. Around the 60-day mark, you'll be ready to make your first key decisions. If you're within 5 years of RMD age, currently 73, now is the time to model the impact of future RMDs and consider whether partial Roth conversions make sense for you. For example, if you're in the 12% federal tax bracket and have $30,000 of room before hitting the next bracket, converting that amount to a Roth IRA this year could save you thousands in future taxes. Remember, Roth conversions are a taxable event, so coordinate with your tax advisor to avoid surprises. If you're charitably inclined and over age 70 and a half, look into setting up qualified charitable distributions, QCDs, from your IRA. These can count towards your RMD and reduce your taxable income. In the final 30 days, the 61 to 90-day window, you'll move into the action phase. This is when you begin executing your chosen withdrawal sequence for the coming year. If you've decided to start withdrawals from your taxable account, set up systematic monthly or quarterly transfers to your checking account. If you're delaying Social Security, make sure your withdrawal plan covers your income needs until you claim your benefit. If you're implementing a Roth conversion ladder, initiate the first conversion and carefully document the transaction for tax reporting. Review your investment portfolio to ensure your asset location aligns with your tax strategy. Growth assets in Roth IRAs, income assets in traditional IRAs, and tax-efficient funds in your brokerage account. During this period, mark your calendar with critical deadlines. RMDs must be taken by December 31st each year, starting the year you turn 73. Roth conversions must also be completed by December 31st to count for the current tax year. If you're making qualified charitable distributions, ensure they're processed before year-end as well. Missing these deadlines can result in costly penalties, up to 25% of the missed RMD amount, so stay organized and proactive. Let's recap your 90-day timeline. In the first 30 days, gather and organize all your financial documents and account statements. In the next 30 days, analyze your withdrawal options, review your investment allocation, and meet with your advisor. In the final 30 days, implement your chosen strategy, set up systematic withdrawals or conversions, and mark all important deadlines on your calendar. This step-by-step process is conservative, proven, and designed to protect your principal while maximizing your after-tax income. Throughout these 90 days, keep a running list of questions and concerns. For example, what if the market drops right after I start my withdrawal plan? Or, how do I adjust if my expenses change unexpectedly? These are normal concerns, and the retirees who succeed are the ones who address them head-on. In my experience, the most resilient retirees are those who review their plan annually, adjust as needed, and never hesitate to seek professional guidance. This is educational content, not personalized financial advice. Every step you take should be tailored to your individual situation, and a qualified advisor can help you avoid costly missteps. Remember, the window for optimizing your withdrawal sequence is often narrow. Every year you wait could mean higher taxes, lower Social Security benefits, or missed opportunities for Roth conversions. Even if you follow this 90-day plan perfectly, you might encounter unexpected roadblocks, market turbulence, sudden health expenses, or changes in tax law. In the next section, we'll address the most common implementation challenges retirees face, and I'll share proven solutions and workarounds that have helped thousands of seniors stay on track even when things don't go as planned. Even if you follow this perfectly, you might encounter these common roadblocks, so let's get ready to tackle them together in the next section. Part 7. Troubleshooting and Problem Solving. Overcoming real-world roadblocks in your $89,000 strategy. Now that you have a clear step-by-step timeline, let's address what happens when real life throws you a curveball. In my 30-plus years working with retirees, I've seen that even the most carefully crafted plans can run into unexpected challenges. The key to lasting success isn't just having a great strategy, it's knowing how to adapt when circumstances change. This is educational content, not personalized financial advice, so always consult a qualified financial advisor for your specific situation. But let's walk through some of the most common roadblocks seniors face when implementing advanced withdrawal sequencing and how you can confidently solve them. Let's start with a challenge that causes anxiety for many: market downturns right after you begin withdrawals. Imagine you've just started your new withdrawal plan and the stock market drops 20% in the first year. It's a scenario that rattles even the most seasoned retirees. Historically, this is called sequence of returns risk, and it can have a lasting impact if you're forced to sell investments at a loss to fund your living expenses. The good news? There are conservative, proven ways to protect yourself. In my experience, the most successful retirees keep at least 2 years of living expenses, let's say $80,000 to $120,000, in cash or short-term bonds. This cash buffer allows you to avoid selling stocks in a downturn, giving your investments time to recover. If the market drops, you draw from your cash reserves instead. Once markets rebound, you can replenish your cash buffer. This safety-first approach has a 40-plus year track record of protecting retirees from devastating losses during market turbulence. Another common challenge is unexpected health expenses or a sudden increase in long-term care needs. Even with Medicare and supplemental insurance, out-of-pocket costs can quickly add up. According to Fidelity, a 65-year-old couple retiring today can expect to spend between $315,000 and $370,000 on health care over their retirement. So, what do you do if you face a $30,000 hospital bill or need to transition to assisted living sooner than planned? First, review your health care coverage annually to ensure you have the right mix of Medicare, Medigap, and long-term care insurance. If a large unexpected bill arises, consider adjusting your withdrawal sequence for that year, perhaps drawing more from your Roth IRA, where withdrawals are tax-free and won't push you into a higher tax bracket. This flexibility is one of the reasons I recommend building Roth assets early in retirement. Many retirees also find it helpful to keep a separate healthcare reserve fund, $20,000 to $50,000 set aside in a high-yield savings account, so you're not forced to disrupt your investment plan when medical surprises occur. Let's talk about another real-world scenario: tax law changes or unexpected increases in tax rates. The U.S. tax code is always evolving, and new legislation can impact everything from RMD ages to capital gains rates. What if Congress raises tax rates, lowers the standard deduction, or changes the rules for Roth conversions? The most resilient retirees review their withdrawal plan every year, not just once at retirement. If you hear about proposed tax law changes, schedule a meeting with your advisor right away. You might need to accelerate Roth conversions, adjust your withdrawal mix, or rebalance your investments for greater tax efficiency. For example, if tax rates are set to rise in 2 years, it may make sense to convert more to Roth now, even if it bumps you into a slightly higher bracket today. Industry insiders know that proactive, flexible planning can save tens of thousands in the long run. A frequent what-if question I hear is, what if I live much longer than expected? With advances in healthcare, it's increasingly common for retirees to live well into their 90s or even past 100. Outliving your money is a top concern. To guard against this, use conservative withdrawal rates, typically between 3% and 4% of your portfolio per year, and revisit your plan annually. If you experience strong market returns in the early years, you may be able to increase your withdrawals slightly. If markets are weak or your expenses rise, consider tightening your belt for a year or two. The most successful retirees I've worked with keep a close eye on their portfolio balance and adjust as needed, rather than sticking rigidly to a plan that no longer fits their reality. Another challenge is family changes or inheritance issues. Sometimes a spouse passes away, adult children need financial help, or you receive an unexpected inheritance. Each of these events can significantly alter your withdrawal sequence and tax situation. For example, after a spouse's death, your tax filing status changes from married filing jointly to single, often resulting in higher taxes on the same income. If you inherit a large IRA, new rules may require you to withdraw the entire balance within 10 years, potentially pushing you into a much higher tax bracket. The solution? Meet with your advisor right away to update your withdrawal plan, review your estate plan, and explore options like charitable giving, Roth conversions, or trusts to manage taxes and protect your legacy. Let's recap some of the practical solutions and workarounds you can use when challenges arise. Maintain a cash buffer to weather market downturns without selling investments at a loss. Keep a healthcare reserve fund and use Roth withdrawals strategically to handle unexpected medical bills. Review your withdrawal plan annually to stay ahead of tax law changes and adjust your strategy as needed. Use flexible withdrawal rates and annual check-ins to ensure your money lasts, even if you live longer than expected. Update your plan promptly when family circumstances or inheritance rules change, working with a qualified advisor to minimize taxes and maximize your legacy. Let me repeat that important point. The retirees who thrive are not the ones who avoid all problems. They're the ones who plan ahead, adjust quickly, and seek professional guidance when circumstances change. In my experience, it's this mindset, combined with a conservative, evidence-based strategy that leads to the greatest peace of mind and financial security. This is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your unique circumstances. No strategy can guarantee specific outcomes, but historically, retirees who plan for these what-if scenarios are far better equipped to weather life's storms and enjoy a fulfilling retirement. So far, we've covered how to troubleshoot the most common roadblocks in your withdrawal sequencing plan. Once you master this foundation, you're ready for the next level. Advanced techniques for maximizing your results, optimizing your plan for the long term, and scaling your strategy as your needs and goals evolve. Once you master this foundation, you're ready for the next level, where you can truly optimize, scale, and future-proof your retirement income. Let's explore those next-level actions and adjustments in our final section. Part 8. Next-level actions and optimization. Scaling your strategy for a lifetime of security and growth. Now that you've mastered the foundation and learned how to troubleshoot common challenges, it's time to look ahead. In my 30-plus years of helping affluent retirees, I've seen that those who truly thrive in retirement take their planning a step further. They optimize, adjust, and scale their strategies over time. This is where you move from simply avoiding mistakes to actively maximizing every dollar, adapting to new opportunities, and building a resilient legacy for your family. Remember, this is educational content, not personalized financial advice, so always consult a qualified advisor for your unique situation. Let's begin with advanced tax diversification, a strategy that goes beyond basic withdrawal sequencing. Many successful retirees use a blend of taxable, tax-deferred, and tax-free accounts not just for withdrawals, but as a way to hedge against future tax uncertainty. For instance, if you've already started a Roth conversion ladder, consider continuing modest annual conversions even into your 70s, as long as it doesn't push you into a higher tax bracket or increase your Medicare premiums. This ongoing approach means that no matter how tax laws evolve, you'll always have flexibility to draw income from the most tax-efficient source. I've seen retirees with $1 million or more in combined accounts save upwards of $60,000 to $100,000 in lifetime taxes simply by keeping this tax diversification toolkit active and up to date. Next, let's talk about dynamic withdrawal strategies. The old set it and forget it 4% rule is no longer enough for today's retirees. Instead, industry insiders and the most successful seniors use dynamic rules, adjusting withdrawals each year based on portfolio performance, inflation, and changing expenses. For example, in years when markets perform well, you might allow yourself a small increase in spending, say, boosting your withdrawals by 3% to 5%. In lean years, you might temporarily reduce your withdrawals or pause discretionary spending. This flexible, responsive approach helps ensure your nest egg lasts, even in the face of market volatility or rising costs. Many retirees I've advised have found that this method not only preserves their principal, but also gives them the confidence to enjoy their money without fear. Long-term healthcare planning is another critical next-level action. As we discussed earlier, healthcare and long-term care expenses can be unpredictable and substantial. The most prepared retirees don't just set aside a healthcare reserve, they revisit their insurance options annually, looking for better Medigap or Medicare Advantage plans, and keep an eye on long-term care insurance products. Some even use health savings accounts, AHSAs, before age 65 to build up a tax-free cushion for future medical costs. If you have significant assets, you might also consider using certain types of trusts or insurance vehicles to shield your estate from Medicaid spend-down rules or to provide for heirs with special needs. These advanced steps can make the difference between financial stress and lasting peace of mind if health issues arise. Let's not overlook legacy and estate optimization. Many affluent retirees want to leave more than just memories. They want to pass on wealth efficiently and responsibly. This often means updating beneficiary designations, creating or revising wills and trusts, and considering strategies like stretch Roth IRAs for heirs or charitable remainder trusts for philanthropic goals. For example, if you plan to leave a portion of your IRA to charity using qualified charitable distributions, QCDs, during your lifetime can reduce your RMDs and your taxable estate. If you have children in lower tax brackets, you might structure inheritances to minimize their tax burden or use annual gift exclusions, currently $17,000 per recipient per year, to transfer wealth gradually without triggering gift taxes. The wealthiest retirees I've worked with revisit their estate plans every 2 to 3 years and after any major life event to ensure everything is current, tax efficient, and aligned with their wishes. Scaling your strategy as your assets and goals evolve is the hallmark of true financial mastery. As your portfolio grows, your needs may shift from income generation to capital preservation or legacy planning. This could mean gradually shifting more assets to safer investments, expanding your use of trusts, or working with a multi-generational advisor who can help your children and grandchildren build on your financial foundation. If you sell a business, inherit new wealth, or experience a windfall, you'll want to revisit your withdrawal sequencing, tax plan, and estate strategy to integrate these changes smoothly. The most successful retirees treat their plan as a living document, one that grows, adapts, and improves over time. Annual reviews and what-if scenario planning are essential long-term habits. Set a recurring date each year, perhaps your birthday or the start of tax season, to review your withdrawal plan, investment allocation, healthcare coverage, and estate documents. Ask yourself, if I lost 20% of my portfolio this year, what would I change? If tax laws shift, am I prepared to adjust my Roth conversion strategy? If a family member needs help, do I have a plan for gifting or supporting them without jeopardizing my own security? By running these scenarios ahead of time, you'll avoid panic and make confident, informed decisions if life throws you a curveball. Let me repeat that important point. In my decades of experience, the retirees who enjoy the most freedom, confidence, and joy in their later years are those who treat retirement planning as an ongoing process, not a one-time event. They seek out new information, adjust to changes, and surround themselves with trusted advisors who understand their values and goals. This conservative, safety-first mindset, combined with advanced optimization techniques, has a 40-plus year track record of helping retirees not only preserve, but also grow their wealth for themselves and future generations. This is educational content, not personalized financial advice. Every advanced technique should be customized to your unique situation and reviewed regularly with a qualified financial advisor or estate planning attorney. Remember, the sooner you begin optimizing and scaling your plan, the more options and flexibility you'll have, and the greater your ability to weather whatever the future may bring. So far, we've explored how to go beyond the basics, maximize your retirement income, and build a legacy that lasts. But there's one final piece that can make all the difference: staying informed and empowered as new opportunities and challenges arise. What I'm about to show you will surprise even experienced investors, because retirement success isn't just about strategy, but about ongoing education and proactive action. Let's move to the conclusion, where we'll tie everything together and reveal how you can stay ahead of the curve, no matter what the future holds. Over the past hour, we've covered a tremendous amount of ground together, delving into the realities of retirement income, the hidden pitfalls that drain wealth, and the advanced, proven strategies that only the most successful retirees use to optimize their finances. Let's take a moment to recap the 8 key insights you've gained. First, we identified the hidden income gap that plagues most retirees and the shocking statistic that 94% are missing out on a strategy that could add up to $89,000 or more to their retirement. Second, we explored the concept of strategic withdrawal sequencing, how the order and timing of your withdrawals can make a massive difference in your after-tax income and long-term security. Third, we discuss the practical step-by-step process for implementing this approach, including organizing your accounts, mapping your income gap, and sequencing your withdrawals for maximum benefit. Fourth, we uncovered the most expensive mistakes to avoid, like taking withdrawals too aggressively, mishandling RMDs, and failing to coordinate with Social Security. Fifth, we introduced advanced optimization techniques, such as Roth conversion laddering, tax-efficient asset location, and qualified charitable distributions that can further boost your results. Sixth, we gave you a clear 90-day implementation timeline with critical deadlines and milestones. Seventh, we addressed real-world troubleshooting, how to handle market downturns, healthcare shocks, tax law changes, and family events without derailing your plan. And eighth, we explored next-level actions for scaling, optimizing, and future-proofing your retirement strategy so you can enjoy lasting confidence and peace of mind. Let me emphasize this important point. The knowledge you've gained today could save you thousands, potentially tens of thousands, of dollars over your retirement. This isn't just financial entertainment, it's valuable education distilled from decades of experience working with seniors just like you. I've seen these strategies work for thousands of retirees across different market cycles, and the most successful clients I've worked with consistently apply these principles to protect their wealth and their legacy. Now that you understand each piece, here's how they work together. By integrating strategic withdrawal sequencing with tax-efficient asset location, annual Roth conversions, and smart Social Security timing, you create a comprehensive, resilient retirement income plan. The compound effect is powerful. For example, a retiree with $750,000 in savings who coordinates withdrawals, delays Social Security, and implements. Roth conversions can often increase their after-tax income by $4,000 to $6,000 per year, avoid costly Medicare surcharges, and reduce their lifetime tax bill by $50,000 or more. Over a 20-year retirement, that's where the $89,000 or even more comes from. This is why wealthy retirees often outperform those with larger starting balances. They use systems and knowledge, not just luck or high returns. After helping retirees navigate multiple market cycles, I can tell you what separates the financially secure from those who struggle is usually knowledge and implementation, not just investment returns. So, what can you do right now to put this knowledge to work? Here are 4 immediate action steps you can take over the next 30 days. Step 1. Assessment phase, first week. Start by gathering your essential financial documents, recent account statements for every retirement and brokerage account, your latest Social Security statement, and your most recent tax return. Calculate your current position by listing all account balances and your annual income needs. Identify your biggest opportunity area, whether it's minimizing taxes, maximizing Social Security, or optimizing RMDs. Step 2. Planning phase, second week. Create your personalized retirement timeline. Note key ages like 62, 65, 70, and 73 for RMDs, and map out when you plan to claim Social Security, start withdrawals, and consider Roth conversions. Research the specific options we discussed that apply to your situation, such as Roth conversion laddering or qualified charitable distributions. Document your current withdrawal strategy and compare it to the optimized approach you've learned today. Step 3. Professional consultation, third week. Schedule a meeting with a qualified financial advisor who specializes in retirement income planning. Bring your organized documents and ask targeted questions. How can I minimize taxes on my withdrawals? Am I on track to avoid Medicare surcharges? Should I be considering Roth conversions or QCDs? Verify that your advisor understands advanced sequencing and tax strategies, not just basic investment management. Also, consider consulting a tax professional and an estate planning attorney to ensure your plan is both tax efficient and legally sound. Step 4. Implementation begins, fourth week. Start with the lowest risk, highest impact change. First, such as adjusting your withdrawal sequence or setting up systematic transfers from your taxable account. Set up the systems and accounts needed for your new strategy, like a Roth IRA or a dedicated cash reserve. Begin tracking your progress with simple metrics: annual tax bill, Social Security benefit amount, and portfolio withdrawal rate. Remember, the goal is to make small, steady improvements that compound over time. Let me emphasize this important point. Every financial strategy carries some level of risk. The goal isn't perfection, it's optimization based on your unique situation. Most successful retirees implement these changes gradually over 6 to 12 months, not all at once. Don't let perfectionism prevent you from starting with small improvements. These aren't get-rich-quick schemes. They're proven, long-term strategies that have stood the test of time. Past performance doesn't guarantee future results, and tax laws may change, so always stay informed and flexible. Remember, your financial situation is unique. What works for one retiree may not be optimal for another. Always consult with qualified financial, tax, and legal professionals before making significant changes. A good advisor can help you customize these strategies, maximize benefits, and ensure compliance with current laws. Estate planning attorneys can help you protect your legacy and ensure your wishes are honored. You're now part of a community of informed retirees who refuse to settle for average. The journey to financial optimization is ongoing. Markets change, laws evolve, and your needs will shift over time. Continue your education by staying informed about new retirement planning developments and sharing your success stories with others. Learn from fellow retirees who are implementing these strategies and help build a culture of financial empowerment for seniors everywhere. If this video helped clarify your retirement planning strategy, please give it a thumbs up and share it with someone who could benefit. Share your biggest takeaway in the comments. What surprised you most, or which strategy will you implement first? Subscribe for more in-depth retirement guidance that could save you thousands. Most importantly, take action on what you've learned. Your future self, your family, and your legacy will thank you. Let me leave you with this final thought. Imagine the peace of mind that comes from knowing you've optimized every aspect of your retirement finances. Sleep better tonight, knowing you have a clear plan for your financial future. You've worked too hard to accept anything less than the best for your retirement years. Take the next step today, because the cost of inaction is often greater than the cost of making informed, proactive decisions. You now have knowledge and tools that most retirees never acquire. Use them to your advantage and let this be the start of your most secure and rewarding chapter